Okay, so in this series, we're gonna look at futures and we're gonna go through everything you need to know about futures. So the goal in this lesson is kind of to just explain what future contracts are, why they exist, how they work in like a plain like professional language, and also give you an example, a very very simple example, and other types of examples that could be there. Okay, so to start off with the basics, what exactly is a futures contract? A futures contract is an agreement between two parties to buy or sell something. This can be if wheat, oil, gold, or in this case, we're going to talk a lot about financial products like the S&P 500 or the Nasdaq, and it's at a specific price on a specific day in the future. Hence the name futures. In other words, it locks in a price today for something that will be delivered or settled later. And so these contracts are legally binding and they're traded on official markets called future exchanges. And for financial products like the S&P and the Nasdaq, they have ticker symbols of ES for the S&P and NQ for the Nasdaq. There's also something called micro contracts where it's MES and MNQ, but we're going to talk about that in another lesson. Why do they exist? At the core, futures contracts are risk management tools. Prices in the market are consistently moving, whether it's the price of oil, corn, coffee, or even the stock market. That movement creates uncertainty. And so if you're running a business or managing a large portfolio, uncertainty is a problem. You need to know what your costs or revenues will look like in the future. And you can't plan effectively if prices are all over the place. This is where futures come in place. Futures allow you to lock in a price today for something that will be settled later. That means whether the market moves up or down, you've already agreed to a fixed price, giving you clarity and stability. This is incredibly useful in an industry where input costs or product prices fluctuate often. By removing the what if the price changes question, futures makes it easier to create a reliable budget, set long-term contracts, and manage risk in a strategic way. And so while individuals do use futures for profit, like trading them, many of the largest users are organizations simply trying to protect themselves from price swings that could hurt their business. I'm going to give you guys a quick example. One of the most important reasons futures exist is to help people in business protect themselves against price swings, like I just mentioned. Let's say you're a farmer and you know you'll harvest your crops in 3 months. If prices fall before then, you could lose money, even if you had good harvest. That's a huge risk, especially if you're running a business with thin margins. On the other side, imagine you're a cereal company. You rely on the wheat. If prices suddenly rise, your costs go up and your profit gets squeezed. This is where a future contract comes in. Both the farmer and the cereal company can agree today on a price they're both comfortable with. Let's say $6 per bushel. For a delivery, that happens in the future. That way, the farmer locks in a guaranteed revenue and the company locks in a stable cost. Even if the market price changes, their deal is already set. This type of futures is called hedging. It means you're using futures to protect against unwanted price changes, and it's not just for farming. Airline hedge fuel costs using oil futures. Coffee shop hedge coffee bean prices, and even tech companies hedge foreign exchange rates when selling internationally. So basically, future contracts allow businesses to plan better, set budgets, and reduce uncertainty. It's about making your future less risky and more predictable. Now, obviously, you could also take a loss. Let's say the future price of a bushel goes under, it goes $4 per bushel. Yeah, you could be making more profit, but at least you took that risk and the price per bushel didn't go up. So types of future contracts. What kind of things can you trade using future contracts? Well, originally futures were created for physical commodities like wheat, corn, oil, and livestock. These markets had big price swings and real-world producers who need to protect themselves. Over time, futures expanded into financial assets. Now you can take futures on stock indexes like the S&P 500, currencies like the euro, the Japanese yen, and even on interest rates. Today you'll also find futures in newer areas like cryptocurrency, especially in Bitcoin. These are typically cash settled and traded on specialized platforms. So there are some things that are all futures have in common. All of them. They have volatile prices. There's a large number of buyers and sellers, and there's a clear need to manage risk. For each asset type, the futures exchange defines the contract size, expiration cycle, and settle method, whether it's cash settlement or physically delivered. Basically, the bottom line is if it has market prices and uncertainty, chances are the futures contracts for it. To kind of to finish it off, we're going to look at what future contracts, what makes them so unique. First, every future contract is standardized. That means the exchange sets all the key terms, the assets being traded, how much of the contract size, and when it expires. You don't customize the details. For example, you could say a crude oil future contract always represents 1,000 barrels. A gold future contract is always 100 troy ounces. And these are kind of like standards that make futures easy to trade at a scale. The only thing traders negotiate is a price. Everything else is preset by the exchange. All future contracts are traded on official regulated exchanges like the CME Group, and that helps ensure transparency, fairness, and enforcement of the rules. Every contract has specific expiration date, usually monthly or quarterly. For instance, the S&P and the Nasdaq are quarterly, so every 3 months. And so that's the date when the contract either gets settled by cash or delivery, or the trader closes their position. And so there are two types of settlements that exist, like I just kind of mentioned. Physical deliveries means the actual asset, like the wheat or oil, is delivered, or cash settlements means the difference in price is paid in money. No asset changes hands. And so basically, lastly, it's important to remember futures aren't about owning assets. You're trading the right and obligation to settle a future date. It's about managing price exposure, not buying something to hold forever.